Yes, at this point in time, some of you may be surprised to learn that credit analysis is applied in industries outside of banks. Now, why is this the case? The aim of credit analysis is to identify the lemons among clients. Credit simply means to extend some form of loan or to allow the client to delay payment. It's like you purchase a piece of furniture such as a sofa set. The shop would probably require you to make a deposit of say 10% and to pay the remaining amount when the sofa set is delivered to your house in 2 weeks' time. The remaining 90% that is owed to the shop is what we call credit that was the shop extended to us. As long as a client makes a purchase and the full amount is not paid on the spot, then it is credit. Think of the corporate world, where businesses sell to other businesses. For example, Shell sells oil to other companies. These companies usually do not pay Shell the full amount on the spot. Typically, it would be 30 days' time that the full amount needs to be repaid to Shell. If the amount owed to Shell is $1 million, then we say that $1 million of credit has been extended by Shell. You may be wondering, is credit therefore a loan? Yes, to extend credit is to give a loan. Therefore, one way to think about credit is that companies are giving loans. These loans can range from 1 week long to even 30 years, like a mortgage loan. Usually, we think of loans to be for long term, but loans can vary in tenure or duration. Therefore, to analyze credit is to think about whether the loan is likely to be repaid by the borrower. If the answer is yes, then a loan is granted. Since most of the loans are made by banks, that's why most of the credit analysts are found in banks. But like I have mentioned, any company that does business and payment is not settled on the spot, then there is some form of credit risk that the company is undertaking. Smaller companies usually have a simple trust-based system to assess customers or based it on gut feelings, friendships between the owners of the companies. That's also the reason why it is usually the larger companies that have credit risk departments, when the scale of credit is large enough to justify hiring credit analysts. Where do credit analysts come into the picture? A credit analyst comes into the picture to assess whether, say, the clients of Shell are able to pay the remainder amount in 30 days. Therefore, if there are 100 clients buying from Shell, then the credit risk department of Shell would have to assess whether or not they should sell to these clients in the first place. Some of these clients may be small companies that do not have the financial capability to repay a huge sum in such a short period of time. Therefore, the recommendation by the credit analyst would be to reject doing business with the client. There can also be instances that the credit analyst assess that the client is only able to pay up to $1 million worth of oil purchased from Shell, although the client hopes to purchase $5 million worth of oil. In this instance, the analyst would therefore recommend giving a credit limit or credit line of $1 million. Anytime that some sort of money is being owed, a credit analyst can come into the picture. Which companies hire credit analysts? Banks and every other company out there. Do you know that car companies, even tech companies like Apple, have their own credit analysts? Do a quick search for credit analyst jobs on job portals and you will be surprised at how diverse it can be. Doing a quick search on job portal LinkedIn for credit analysts, we see that there are several banks looking to hire credit analysts. However, we also see a diverse range of companies, such as what I have found here to be a cement company called Argos, as well as a food company called JBS. Even Porsche, which everyone knows about this famous sports car company, also hires credit analysts. Then, there are specialized companies called credit rating agencies like S&P, Moody's, and Fitch. They are comprised of mostly credit analysts because their core business is to produce credit reports. These are just the tip of the iceberg. Clearing misconceptions, what is credit analysis not about? Credit analysis is not accounting. It is not auditing. It is not rocket science. You do not need to have a CFA to be a credit analyst. You do not need to have an MBA. Credit analysis is not just about looking at figures on the balance sheet. It is not financial modeling. However, a credit analyst can build models to help in the analysis. Let me explain a little more. A model is not rocket science. Basic models are used very commonly in many companies. It means opening up a Microsoft Excel spreadsheet, input the revenue for the past 3 years, and using it to predict the revenue for the next 2 to 3 years. Repeat the process for earnings, for debt, for cash flow, and so on. And that's the basic essence of modeling. As a disclaimer, I am definitely no expert in conjuring up complex financial models. To date, many banks and companies have been trying to replace the role of human credit analysis to predict which clients would default on payments. However, it has been largely unsuccessful as the model is only as good as the data provided. Financial models cannot predict recessions like COVID-19, and the programmer will have a hard time tweaking the program every few weeks or months to account for events like trade wars, protests, presidential elections, natural disasters, some of which of these events can actually be rather random. Therefore, companies would usually use models on clients that they have low exposure to. Low exposure means that the clients are extended a very low credit limit by the company. The definition of low differs from company to company. Depending on the management, low can be a cut-off limit at $100,000 or $1 million, or basically any arbitrary figure decided by the boss. And based on what we have seen in several companies, the models used are extremely simplistic and nowhere near the complexity that is being taught in this course. Credit analysis is also not about choosing which stocks to buy. The output of a credit analyst is not a stock price. However, having said that, one can use the skills picked up in credit analysis to study whether the company's stock price is on a rising or decreasing trend. It is useful for mid to long-term trading on the stock market, but not a good tool for short-term stocks trading. For instance, the stock market is often influenced by emotions, which we will not include in a credit analysis. Sometimes, irrational investors can drive stock prices up, despite the announcement of a company filing for bankruptcy. Credit analysis is an art as well as a science. A credit analyst considers many aspects and perspectives to derive a conclusion on whether the company will default on its payments over the next 12 months. It also considers whether the company will actually improve on its ability to pay back its loan. This means that a larger loan can be granted to the client if the creditworthiness is high. Science would refer to just studying the numbers in the financial statements. But that is just one portion to a good credit analysis. A good credit analyst also considers other soft aspects such as the quality of the management. Does the CEO have a good track record of leading the company out of crisis, or is the CEO young and inexperienced? This is the artistic side of credit analysis. There are many other factors to think about. This is because while numbers are on the financial statements could look good, sometimes the figures can be falsified. Sometimes there is window dressing of the balance sheet to make it look as though the company is healthy. In many smaller and medium-sized companies, the financial statements are not required to be audited or be subjected to scrutiny to the extent of public listed companies. It is often more challenging to analyze these financial statements. For instance, I have seen companies whereby its directors, also commonly known as owners or bosses, withdraw more money from the company apart from their usual means of salary, directorship fees, and dividends. Sometimes, directors receive consulting fees, which actually makes no good sense, as in one case that I came across of a bicycle selling company. Why in the world would dubious consulting fees be charged? The reason is that the director would want to draw out money and treat the company as his or her personal bank account. Company accounts and personal bank accounts should be distinct. Otherwise, this can lead to the company reporting lower profits. Sometimes, directors take personal loans from their own companies and subsume those loans under liabilities on the company's financial statements, without needing to pay interest. There are often many reasons why smaller companies would want to play around with the figures on a financial statement, and a good credit analyst should question what they see rather than believe it wholesale. On the other end of the spectrum, I have also seen directors lending large amounts of money to the company, such as tens of millions. Again, we got to understand the consequences of doing so. Why would someone endlessly pour money into a loss-making company? Isn't the usual practice to simply close it down? What are the key skills that a credit analyst should have? A good credit analyst is like an investigator. Remaining objective and impartial is important. You will need a keen eye to sniff out clues and spot suspicious points or even news about the company. A curious investigative mind is therefore important. For instance, you want to know who are the shareholders of the company. Are the shareholders themselves able to provide financial support to the company? Or could the shareholder just be another company that is insignificant among the grand scheme of things? Then, who is the ultimate shareholder? This is often one of the key things to look out for when studying the ownership of a company. Ownership is important as we want to know the source of funding, the management background, and so on. For instance, many shipping companies are registered in limited jurisdiction regions like the BVI, Marshall Islands, and so on, where they are not required by law to file their annual financial statements or even disclose who the owners are. For instance, each shipping vessel is registered as one company on its own. If we were to analyze a credit profile, we have to trace who ultimately owns the company that owns the vessel. I have done this on many occasions, and it is important, especially if that vessel is trying to purchase fuel from an oil company, and the credit analyst in the oil company would have to look at the financial statements of the ultimate parent company rather than that single company owning one vessel. These companies are actually known as Special Purpose Vehicles or SPVs. The reason for this is that it is easy to pretend that a company has low debt when all the debt is concentrated in the ultimate parent company, hidden somewhere in a BVI. If we do not know the extent of the total debt for the entire group, and we focus only on that single entity, we have a highly skewed idea of the debt profile, and we can mistake that there is low debt leverage, when the truth could very well be that the entire shipping group is facing bankruptcy over the next 6 months. So is this a common situation? Well, from my own experience, it is very common. Companies have often tons of incentive to conceal the true financial situation that they are in order to look good on the outside to obtain loans at low interest rates. A credit opinion reflects both the art and science of credit analysis. Usually, the opinions among seasoned analysts are very similar. This course will take you through the art and the science to equip you with the skills to come to your own credit opinion. History of credit analysis. Now let us talk about the history, a brief history of credit analysis. The concept of credit may seem like a fairly new invention, but it's actually been around for more than 5,000 years. In fact, many millennia before the credit score became common, there is historical evidence that cultures around the world were borrowing for various reasons. From the writings in Hammurabi's Code to the exchanges documented by the ancient Romans, we know that credit was used for a purpose such as getting enough silver to buy a property or for agricultural loans made to farmers. So in 3500 BC, Sumer was the first urban civilization with about 89% of its population living in cities. It is thought that here, consumer loans used for agricultural purposes were first invented. The birth of modern consumer credit. In 1803 in England, it was where credit reporting itself originated. The earliest available account is that of a group of English tailors that came together to swap information on customers who failed to settle their debts. In 1899 in Atlanta, the Retail Credit Company was founded and began compiling an extensive list of credit-worthy customers. Later on, the company would change its name to Equifax. Today, it is the oldest of the three major credit agencies in the United States. The consumer credit boom. In 1808 in Detroit, Henry Ford's Model T makes automobiles accessible to the common people, but they were still too expensive to buy with cash for most families. So in 1819, General Motors solved this problem by loaning consumers the money that they need to buy a new car. General Motors Acceptance Corporation was founded and popularized the idea of installment plan financing. Consumers can now get a new car with just a 35% down payment at the time of financing. So in 1958, Bank Americard, now Visa, is dropped in California. American Express and MasterCard soon followed, offering Americans general credit for a wide range of purchases. Is credit analysis same as accounting, since both look at financial statements? In this section, we will be discussing about the similarities, differences, the deliverables, job types, and the different opinions of credit versus accounting. At this point in time, you may be wondering, since both credit analysis and accounting require looking at financial statements, what are the key differences? The key similarities we will start with would be both credit analysis and accounting would require good knowledge of the financial statements. Where it differs is the deliverable. Accounting is to produce financial statements, or some accountants that do auditing examine for frauds or irregularities of the financial statements. But a credit analyst will base their analysis on financial statements, taking what is written there to be generally factual. Of course, it may not always be the case. Within the financial statements, you will also realize that the accountant or the auditor will give a qualified or unqualified opinion. The main role of an accountant is to ensure that accounts are done up to international standards to be factual. On the other hand, the role of a credit analyst is to come up with a credit opinion rather than a qualified opinion on whether this client company is worth making a loan and how big the loan should be. What are the types of credit analysis? Credit analysis can be carried out on any company in the world. However, it is useful to have some division between the types of companies. The most common type of breakdown would be general corporates, banks, and non-banks financial institutions. General corporates will refer to your usual companies. Banks are just banks. Non-bank financial institutions, or NBFI, are insurance providers, mutual funds, private equity firms, and so on. The reason for this segregation is important because the way credit analysis is conducted for these three categories are different. For instance, we would examine the non-performing loans for banks, which is an important credit metric. However, this is something that is not applicable for general corporates. What happens in companies, and why do they need credit reports? The best way to answer this question is to visualize a real-life scenario in a company. The sales team will bring in new sales, a new company who wants to buy a product. Let's say that using the same example of Shell, the oil-producing company. The sales team at Shell has brought in a new client who could be a power plant operator located in Indonesia. The power plant operator wants to buy $1 million worth of oil every month. Rather than simply saying yes when any new clients want to buy, the sales team obtains the financial statements of the power plant for the past 3 years. Because this is a new client, there are no past records or dealings. No one can say if the power plant would be able to make payment for the $1 million at the end of each month. Therefore, financial statements are then passed on to the credit analyst in Shell. The credit analyst would then appraise the financial statements and other factors related to the power plant. If the final credit report says that the power plant will be able to pay for the $1 million every month, then in this simplified scenario, Shell would do business with the power plant and sell it oil. Otherwise, Shell would reject the deal and the power plant operator has to look for a new seller. This is also the same case for a bank. Instead of Shell, let's just say that a small textile company wants to borrow $500,000 from Standard Chartered Bank to build a new factory. Without this loan, the small textile company would probably need 20 years to slowly save up the same amount of money. When the sales team from Standard Chartered Bank sees this textile company, it would also obtain the financial statements and submit them to their credit risk team in the bank. The credit analyst would study the terms of the deal, such as the interest rates to be charged every month, whether collateral is needed for the loan, whether the loan is too high or too low, and so on. The case could then be presented to a credit committee in the bank when the loan is very big, and final approval is obtained to probably make a $500,000 loan to the small textile company. What are credit terms? Credit terms can also be thought as the terms for the loan. The most basic credit terms are the duration of the loan, date of repayment, and the amount of loan. The amount of the loan is also the credit limit. Not every company will make full use of their credit limit. Sometimes they would only require goods worth 50% of their credit limit. The credit limit refers to the highest loan amount that a company can obtain.